March madness, and it took us a while to get through it.
So we lived through a funding crisis that was created because of a loss of trust. Banking is based on trust. And if trust goes out the window, bad things happen. The good news is the flashing red is behind us, but we're now in the flashing yellow phase. We're going from liquidity to capital, and from financial contagion to economic contagion.
How bad will it be? So we talk about a credit crunch. First of all, if there is a credit crunch because lending basically freezes up and a lot of people don't have access to capital and they need it, how long does that take?
So it takes a long time. This is not 2008. 2008 was a sudden stop where things just stopped because the payments and settlement system was in play. This is very different. This will play out probably in the third and fourth quarter, and it will have a long tail. So it is very, very different from what we've experienced before.
Is there anything that policymakers can now put in place to cushion that?
Well, the first thing is to fix past mistakes. This was, as admitted by the Vice Chair Barr, a major lapse in supervision. This should not have happened, but it did happen. So the first thing to do is to make sure that with the existing regulation, there's better supervision. Then there is a potential for some tweaks to regulation, but we must be really careful because if we go overboard on regulation, this will cause banks to be even more cautious.
But what's the next thing to fall? I don't know whether if you look at SVB, but also Credit Suisse, and we understand it was a problem basically run on the banks. It was people fearful about their deposits. Is there something else that could break?
Yeah. So when you have three things coming together, inherent fragility. Both SVB had a balance sheet fragility, and Credit Suisse had a business model fragility that had been there for a long time. Two is when you have interest rates that weren't increased in time and therefore accelerated in a very short amount of time. And then third, when you have amplifiers in the system, you get what we have. In terms of what next, I actually worry less about a banking crisis as much as I worry about the consequences of what we've already seen.
But does something like Credit Suisse, I mean, it's really incredible, actually, the speed at which it happened. And we always know for many years that it had a model problem, but it's just gone, right, in like the space of a week. Could it happen to someone else?
Sure, it could have. I mean, if you lose trust in a banking institution, it is very difficult to save it. I often step back and say, Switzerland's second largest bank is gone.
It's incredible.
One of the 30 systemic banks are gone, and they went just like that. We now heard that Silicon Valley Bank not only lost 42 billion on the Thursday, but was set to lose 100 billion of deposits on the Friday. Things move at the speed of sound. And regulators and supervisors have to realize this because when you have a lapse in supervision, the risks of fragility are very large.